Great.
So you can see the screen.
Yes.
Shall we start then?
Yeah, please.
Okay. Yeah, hi. Good afternoon, everyone. This is CS Rupali Mittal. So today we'll be discussing about the startups. It's really a very important and a very interesting topic these days, and investing in startups, right? So you must be surprised to know that today, in what we are today as startups in India, is what US was in 1970s. So we are way back than US, but yeah, we are coming up very soon, and we are covering almost 10 years in just 2 years, right? So I'm sure, and I can vouch on it that the way we are growing up with the startups will be what in next 10 years the maximum unicorns would be from India only. So that I can vouch on it. So now from the investors' point of view, why startups are getting interest in the startups? Because we the people in India, what we used to do for the investments, we generally used to invest in mutual funds, or we invest in the gold or in the property. But this is the new secondary investment coming up for the investors, so they want to invest themselves in startups. So now a lot of questions comes up with the investors. So today we'll be discussing some of the points, like what is a startup, what factors are there to invest in a startup, what are the instruments to invest, what are the stages of startups, how to invest in startup, so how the valuation is done in a startup, what are the convertible notes, and how do investors earn out in these startups, what is the maximum stake in startup, the fundamental analysis and due diligence, I mean, what you have to take care while investing in startup, the documents required, whether shares can be transferred or not, and if yes, then what is the process of transfer of shares, what is the tax liability on sale of shares, and what is the exit clause, which is very important for any startup, right? So what's in startup? So a idea, a vision, a a vision which can be repeatable, an inspiration, a business model, analysis, funding, development, innovation, teamwork. So, what I would say is a startup is a young company founded by one or more entrepreneurs to develop a unique product or services and bring it to the market. Or I can also say that any process or maybe a problem which otherwise could be solved, wherein a person is clearly using a technology for the growth and productivity, can be termed as a startup. So I always say that investment in startup is always a J. So why J? Because when you invest in a startup, initial years or for the initial time, your investments go down. But when it takes escalation, then your investments goes like this. So I always say that start investments in a startup is a J curve, right? So now we'll be discussing, what are the these are the startups which are very popular, like Ola, Swiggy, Groovers, Policy Bazaar, Paytm, Flipkart, Oyo, Unacademy. So these are very popular and known startups. So now what are the factors involving startup? So we all wonder, right? Suppose somebody says they have an idea, right? So is it a right startup to invest in? So there are few factors, though there is no science behind it. It's all over the gut feeling and the understanding. So however, there are few factors, some are tangible, some are intangible factors. So I'll be discussing some of the factors which are important while planning to invest in a startup. So one is a large market, the tangible factor. So large market means, okay, I'll take an example for Ola. So when Ola came here for the investment and Ola was there, so Ola market was a very large market. It was catering everybody because people were ready to go use Ola, to use the cabs for a smaller distance as well. So Ola has a large market. It has a high frequency market wherein it will be used multiple times. It's not that person is going to use once. For example, there is a startup who delivers milk, right? So they deliver the packet milk. So it's a daily thing wherein people need them on a daily basis. So it's a high frequency case. So that means whether it's a scalable or not. Then asset light models. So I always say that asset light models. So where the startups, they use a lot of assets. So there's a lot of capital involved in that. So such startups are less scalable than the startups which are lighter in the models, which use less of investments or heavy machineries. Then founding team. Founding team is very, very important in this startup, because founding team is the person who is having an idea, who will be working for the startup. So it's an entrepreneur. So who are the founders of the startup? What is the background of the founders? What are they doing? And are they still doing some job, or they have left their high pay jobs? So that founding team is very important to know what understanding the founding team is. Are they clear in their concepts? That's important. Then product differentiation and competitive advantage. So what product the startup has? So whether that product is already into market, or that's something a new product. It's a competitive product. So it's very important to analyze what type of product the startup is into. Then there are some intangible factors. So these intangible factors are which we cannot see, but we can feel that. So what's that? Intangible factors are comfort within the founder. So if we have 2 3 founders who have teamed up together for as a startup, so what is the comfort among themselves? So there is always a fight among themselves, or they complement each other. That's very important to know about the founders. Then it's not only comfort within the founders, but the comfort of an investor with the founder. That's very important. It's not necessary that you always take a board seat in a company. But despite not taking a board seat, there should be some comfort with yours, with the startup. That's important. Then this is a founder. That's very important, because there should be a person the founder should be a person who should take decisions, who should not delay the decisions. That's important for a startup, because they don't have much time. So they should be taking the decisions whether to do it or whether not to do it. So there should be a decisive founder. Then articulated means the person should be very clear and should be very smart in telling his story, in selling his concept. That clarity is very important. And then clarity of vision. So he should be very clear with his vision, what he wants to achieve. That you can make it out while having conversations with the founders. So these are the factors which we should consider. Then what are the types of the investments? So these are the investment instruments, the share and the debts. So what are the shares? The shares, okay, I'll tell you in detail. So types of shares. So shares is basically a capital of the company, right? So you're getting the shares in the company, and you're becoming an owner of the company. But the founders are having 100% shares, and you're getting some percentage out of that equity share. So that's equity shares. Then there is a preference shares. Preference shares is a convertible unit. It is not an equity share, but it is a preferable share which gets a preference over equity, but you don't get the voting rights. The voting rights are only up to whenever your rights are there, or there is some infringement of your rights, then voting rights come up. So these are the preference stocks. Preference stocks can be the cumulative, non-cumulative. What is cumulative? So when you're taking a preference stock, there is a percentage of dividend being given to you on preference stocks. So cumulative preference stocks are those when a company doesn't have a profit. Then in the next year, when the company is having a profit, then your previous year's dividend will also be payable to you. And the non-cumulative preference shares are like in 1 year the company doesn't have profit, then your right to get the dividend in that particular year will not be carried forward, right? And then there'll be a convertible preference shares, those preference shares which can be converted into equity. That this I will be telling you in detail how the convertible notes work in my next slides. And then non-convertible debentures, who are redeemable debentures. You can redeem them after a period of time, like you cannot issue the shares which are redeemable not more than 20 years. So they have to be redeemed within 20 years. So the type goes in like equity, which is a common stock, and a preferred stock, which we commonly known as CCPS, right? Convertible preference shares. Then there's a type of debts. So debts comes out the debentures. So there's one more. Debentures are not the capital of a company. Debenture is a loan. That means an investor is giving a loan to the company, which can be secured, which can be unsecured, which can be convertible into equity, or which cannot be convertible into equity, right? So a company can go in either of the format, the shares or the debenture. So these are the typical instruments. But somehow in the early stage, generally the founders doesn't should not go for the debentures, because if you're investing as an investor, also if you're investing in a debenture, how will you make yourself assured of that the company who's taking a loan will be able to pay you back the loan, right? So that's very important to understand that why the founder is taking the debentures, they're taking a loan in the initial stages only. And in case they say, I'll give you some security on it, right? Then why can't he's taking a bank loan instead of having an investor there? So that's important to understand when to take a debenture or when to go with the stocks, right? So these are the bonds, these are the convertible bonds, the share warrants or the bonds, which also, that's another instrument which a company issues, which are convertible into equity at a later stage of time. That depends upon your agreement. This I'll be covering in detail. Now I'll be discussing about the stages of startup. So these are the stages. So this is a pre-seed stage, then a seed stage, then a series A, series B, and IPO. So, any science behind these, like pre-seed, seed, series A, why this terminology is being used? So there is no science behind it. It's just that we say it as a seed stage, right? Because it's a stage from where the concept starts growing, right? So basically it is referred to. So if you say a banyan tree, it has got a seed which is a very small seed, but it's a huge tree when it grows up. So that's why we call this stage as a seed stage. So what are these stages basically? So the pre-seed stage is a stage when a person is having an idea and the person is setting up the entity to flourish that idea. So this, at this stage, it's basically the self-financing or the family or a small finance is required. So self or a family financing. Now comes the seed stage wherein he is having a concept with which he has to work with. So here the angel investors comes in. So who are the angel investors? The investors who invest individually, right? Or a crowdfunding. That is, crowdfunding is like small investors who are investing. Somebody's investing a lakh or 50,000 or something. So that's a crowdfunding. So generally, crowdfunding is very early stage. Then angel investors are investors who are funding into the company for an amount which can go up to 2 crores, 3 crores, or in some startups it is going up to 7 crores. So the seed stage is a stage wherein the person is having a concept. He has sold his concept to the individuals and who like that concept and invested into the company. So seed stage is to grow up the concept. Now the Series A funding. So what is a Series A funding? Series A is a professional funding wherein the professional players comes in, the organized players comes in for this Series A funding. Series A fundings includes the venture capitalists, the private equity players, right? Then, and when in Series A funding, so there are some targets being given to them. When the company completes those targets, then they go to Series B funding, right? Again, Series B funding. So Series B funding is a funding which is over and above a Series A. The new investors are coming in. So generally, the seed stage funding, like in US, the seed stage funding is what, $15,000. Here in India, if somebody calls you up and says, I want a seed stage funding for 5 crores, right? So you need to understand why that founder is saying that at a seed stage, one shot they need a 5 crore rupees. Because seed stage is basically for just to start up with the concept. So it generally needs a crore, 2 crores, 3 crore rupees to lay down the base, right? Then so seed stage is generally 2, 3 crores, which at times goes to 5 crores, 7 crores, but it depends upon the type of the startup. Then Series A funding, which generally starts from like 5 crore, 10 crores, it goes up to 25, 30, 40 crores. Then seed B funding, then it goes to another level. Then we have another series, Series C, Series D, Series E, so on, so on. But next series comes in when whatever the targets are given in one series is accomplished, and then the next round of funding is coming over. Then there is one more concept, like between two series, it's a mid series or a pre-series funding. So what is mid-series or a pre-series funding? A mid-series funding is, suppose in series A you have some targets, but with the capital what you have whatever the funds you have raised, you're not able to achieve your target with those funds, and you'll be needing more funds. Then before going into another series, you take a pre-series funding. So that's called a pre-series funding. Then it's an IPO. So once a lot you have received the funding, you have grown up actually, then you can go public. So public means you can come up with your IPO, you can get your company listed. So these are the stages basically: the pre-seed stage, the seed stage. So pre-seed stage is self-funding. Seed stage is family, friends, or the angel funding or the crowdfunding. Then series A, series B. It can go to any amount, any series, right? And then the company goes to for a listing. That's IPO. Now, so we have understood that these are the series, right? Now, an investor will ask, how can we invest, right? The startups are either the companies or the LLPs, right? So in the companies, you can invest by having the equity shares, the CCPS, their debentures, and in LLP, you can contribute as a partner. So I'll understand what is a company and what is an LLP. So a company, we all know it's a old format. It's a private limited or a limited company, which is having the equity shares or which is having the different type of shares with it. And LLP is basically a hybrid between a company and a partnership firm. So here the contribution, the capital is called as a contribution. And in case you have to invest in an LLP, you have to become a partner in that LLP because a shareholder has to be a partner in LLP. In company, if you're investing and you don't want to take a board seat, then it is not mandatory for you to take a board seat. However, if you want, you can discuss it with the founders. If you see, but I will suggest you should take a board seat as an angel investor only when you think that you can give something to the company. Otherwise, it's an additional responsibility because being a director, if God forbid the founders have done something wrong, they have some fraudulent activities in the company, right? Then as a board member, the onus becomes you. Then you have to prove the fact that you're not guilty, you're not involved into that fraudulent activity, right? So a board seat comes with the responsibility as well. So, and in LLP, you have to become a partner before investing because a shareholder has to be a partner in LLP. So generally, LLP is not a very, very common or a very known sort of investment because here there are few restrictions in the LLP. First, I told you have to become a partner in LLP. Then you don't have many instruments in LLP. Like in company, you have a lot of instruments. I told you have equity, you have CCPS, you have debentures, you have warrants, you have bonds. So you have different type of instruments in a company, but in LLP you don't have multiple instruments. Then the voting rights. In company, if you're having an equity shares, you have one vote for your one share generally. But in LLP, I mean the rights are not such distributed. So if you become a partner, right, and the other person who's a designated partner who plays more role, they might take the influence, and they will not ask you anything and they'll take the decisions. So that's a and these are certain limitations with the LLP. So generally the venture capitalist or the investors go for the company sort of formation. I'm sorry, investments in a company sort of organization. So these are the direct investments. So these are also known as the primary investments, investment in equity, CCPS debentures, or a contribution as a partner. Then, when you are investing in a startup, right? So a question comes up: valuation of startup. So what is a valuation of a startup? How will you be able to value the startup? Valuation of a startup is actually a you know eh, it's very tough to value a startup because there is no such science. People say whether valuation is a science or art, right? So what I say, valuation is actually not a science. Okay, so you have some formulas, the registered valuers or the merchant bankers use some formulas so to value that company. But as a layman, as an investor, you cannot you cannot apply those formulas or understand the valuation using that science, right? Moreover, the startups generally don't have the track record. They don't have the cash flows for the valuation, right? So how will you value a startup? So I've told you. So the how will you value a startup? So you'll be see what is the potential of the investment in that startup, right? You will see what is the risk involved in that startup. So I mean, how much is the upside you're looking for, the risk you are taking for a startup? So there are certain points which are there to see that when you're valuing for a startup. So there are few things like a few methodology like capital raised versus equity dilution, or its venture capital expected return approach, or a comparable recent transactions risk factor summation, discounted cash flow, first Chicago method. So I'll be discussing in detail about the capital raise versus equity dilution because this is the most common method. But yeah, venture capital expected return is this is the valuation done by the venture capitalists. So now they are bringing up the huge amount. So they see what is their expected return. For example, in 3 years, they are seeing that expected return of 5 years or 7 years. This much is they are expecting the return, so they value accordingly. Then there is a comparable recent transaction. So supposedly in a startup, you can compare that the person is having these much of users, so this is the value, and this will be multiplied by the users will multiply 20x, for example, in 1 year. Then what would be the value in 1 year? So that way you calculate in comparable recent transactions. Then DCF. DCF method is basically a it's a scientific method. It is a formula driven method wherein you calculate the future values of a transaction and you discount them for the future. So this is the DCF method. So DCF method is used by the valuers to value the startups. Then there's the first Chicago method. First Chicago method is wherein you think of a scenario, the worst case scenario. What will be the valuation of a startup in the worst case? Suppose the startup doesn't work. Then what could be the scenario when the startup is working? And what could be the best case scenario? Right? Then you average them and then you reach out to the valuation. So these are certain methodologies. We'll be discussing capital raise versus equity dilution in detail with an example. So here I'll show you an example. So here we have I'm taking an example wherein we have a founder and there was some ESOPs. ESOPs are employee stock option schemes which have been issued to the employees of the company. So the founder is having 90% of ESOP, and in a seed round, a seed investor is coming in with 1 crore of rupees, right? And he's investing 10%. So with 1 crore, you're investing 10%. So what is the post money valuation? That comes out to be 10 crore. It's a mathematical calculation that with 1 crore, if it's 10%, then what is the 100%? 100% is 10 crore of it, right? So this is a seed round. Then seed A round, sorry, series A. When you are having a series A investor, the investor is coming up with 15% at and investing 3 crores of rupees. So what is the post money valuation? If he's investing 3 crores with 15%, the post money valuation would come out to be 20 crores. Right now, here I'll tell you how your valuation changes for the angel investor. So the angel investor has earlier invested 10% for 1 crore. Now, right now, after the series A, the investor comes in, the valuation of a company is 20 crores, and since the series A round investor is coming with 15%, the seed round investors goes to 8.5% because 15% is given to series A, and the founders and the ESOPs go, I'm assuming ESOP is same, right? Then the founders equity goes to 76.5%. So what is the valuation of an angel investor? It's comes out to be 1.7 crore, which is 8.5% of 20 crores. Okay, so this is the valuation of the angel investor at the time of series A round. So what is the percentage of increase in the valuation? So again, so earlier your valuation was 1 crore when you invested. Now the valuation is 1.7 crore. So the increase in valuation is 1.7 crore minus 1 crore divided by 1 crore, which is 70%. So 70% is your increase in valuation. I hope I'm clear, right? Now we are having series B round. So this series A round is finished. Now we are having series B round. So the investor is coming with 20% of investment at 30 crores. So the person is investing 30 crores at 20%. So what is the valuation of the company comes out to be 1.150 crores, right? So it's a simple mathematics. 20% at 30 crore, what would be 100%? It is 150 crores. Now, what is the valuation for an angel investor who has invested 10% and 1 crore? So now his he was 8.5% after series A, and this was the founder 76.5. Now when the new investor comes into 20%, The investment for angel investors goes down by 20%, which is 6.8%. Then the Series A funding will also go by 20%, so it comes out to be 12%. And then the founders, it will go by 20%. So the founders percentage would be 61.2%. Now we'll see how the valuation for the angel investors, what is the valuation for the angel investors? So now the angel investor is 6.8%. So valuation of the angel investor would be total valuation of a company multiplied by his percentage. So that comes out to be 10.2 crore. So after Series B round, how your valuation changes, like, so earlier you invested 1 crore, now your valuation is 10.2 crore. So what is the increase in the valuation of an angel investor? Which is the valuation for the angel investor, which is after Series B is 10.2 minus 1 crore divided by 1 crore, that's 920%. So after Series B round, the elevation of an angel investor from 1 crore goes to 10.2 crore. So there's an increase in 920 percentage of the valuation, right? So this is how the valuation goes up. But now I'll also show you that with every new investment, your shares get diluted, right? So this is the example. I'll take the same example in the next slide. So I hope you have understood this seed round, Series A round, Series B round, right? So this is also a cap table. Generally, cap tables are made like this. So now you have a founder. Earlier we were just working with the percentages. Now I've said a founder is having 89,000 shares. ESOP is 1,000 shares. So the number of shares would remain same. Now at seed round, the investor is coming up with 1 crore rupees, right? So the post money valuation would come out to be 10 crore. Then what is the pre-money valuation? So pre-money valuation is the valuation of a company minus the investment amount which is coming in that valuation. So the pre-money valuation would be 9 crore in this case, right? So this is the pre-money valuation. And what were the amount of the shares? 90,000, because a founder plus ESOP. So what would be the price of the share? That I would say A minus D. A is pre-money valuation divided by D, shares pre-money valuation. So what were the number of shares? So that was 90,000 rupees. So 9 crore divided by 90,000 would be 1,000 rupees. So that's a price per share. Now the investor is coming up with 1 crore, right? And price per share is 1,000 rupees. So how much shares would be issued? So investment amount divided by price per share. That means E is A upon D. So price per share. So this is the number of shares issued to the angel investor, which is 10,000 shares, right? So here we have issued 10,000 shares to the angel investor. Now, what is the, after investment, what is the price of the share? It will remain the same, because again, what we will do, we will divide post money valuation 10 crore divided by the number of shares which were there before valuation plus the number of shares issued. So it again remains the same. So here in seed round, this is the scenario now. Founder is having 89% shares, and founder plus ESOP is having 90% shares, and then your angel investors have 10%. Now in Series A, we say is that investor brings in 3 crores of rupees, right? So the post money calculation, we have already seen how to calculate it. It becomes 20 crores. Now, what is the pre-money valuation? That would be post-money valuation minus the investment amount is the pre-money valuation, that is 17 crores. Now, at the time of, when the investor is coming in, how many shares you were having? The D, shares pre-money valuation. You were having 1 lakh of shares. So these 1 lakh shares, right? So what is the price per share here? This is the pre-money valuation divided by 1 lakh, that is 1,700. This is the price per share, right? Now, how many shares would be issued to the Series A round? So 3 crores divided by 1,700, which comes out to be 17,647. So if it is coming in round figure, it's coming in points, we generally round it off. So this is the number of shares issued. And again, what is the price post investment? It's again post money valuation divided by total number of shares after the investment. It's again coming out to be 1,700. So this is the new cap table, that founders 89,000, angel investors 10,000. And now you see your shares remains the same, right? But with the new investor, Now your percentage of share in the company comes to be 75.65%, because now you will calculate the percent with the total number of shares issued after investors. So this is 75.65, 8.5, 15%, Series A, and ESOPs goes to 0.85. Number of shares remains the same. Your percentage is diluting, right? Now we discuss about Series B round. Series B round, wherein the investor has got 30 lakh rupees, right? So the post money valuation was coming out to be 150 crore, because he was coming up with 20% at 30 crores. So it is 150 crore post money valuation, right? So the pre money valuation comes out to be 120 crores here. Again, what were the shares pre money? The shares at the time of investment would be 117674. Then what is the price per share? Again, pre money valuation divided by the shares at that time, that comes out to be 10,200. Then number of shares issued to the Series B round. In the Series B round is 30 crores divided by the price per share, which comes out to be 29,412. And again, the price post investment, the value of the share post investment would be post money valuation divided by total number of shares. So it's again 10,200. So this is the new cap table after Series B. So your number of shares, see, the shares for founders, angel, Series A remains the same, but their percentage has diluted from 75 to 65 to this. So here you can see the founder has diluted their investments from 89% to 60.52%. So you see, and so here I hope I'm clear about it. So I'll also tell you one thing, that you need to check how much the founder is having the share, because shares are basically the skin of a startup, right? And if the founders are not having the skin, then their interest for working towards a company will go down, right? So eventually, maybe after a lot of series, the founders shares may go down, but initially the founders keep the maximum stake with them, so that people have more faith and interest in them, because shares are the skin of basically a startup. And so it's very important for the founders to keep the skin with them, I mean to keep the shares with them and dilute as less as possible. So these are the dilutions after Series B, right? I hope you clear that how your valuation works in every round, and how your shares get diluted after every round, right? Now, convertible notes. So I told you that the company shares. I told you that the instruments for startups are equity. So equity are the shares, the common stocks which are being given to you. They are not convertible. They are as it is stocks being given to you. Now, I told you the preference shares, the debentures, the warrants, the bonds, right? So these are the instruments which are given with the condition of convertibility, that these CCPS or debentures or warrants could be converted into shares after some events, right? So those are the convertible notes. So it's a convertible note is a form of short term note that converts into equity. In effect, the investors would be lending money to a startup, and instead of a return in the form of a principal, they'll get a return principal plus interest, or maybe in case of like preference shares, I told you they'll get some dividend. The investor would receive equity in the company after a period of time, right? So so these are generally 18 months conversion period, maturity period, or 24 months maturity period. These are small period maturity funds, convertible bonds. So there are certain parameters involved in the convertible bonds. So whenever you're having a convertible instrument, right, CCPS or debentures, then there are few factors. I'll tell you how these factors work with the illustrations. So the factors are, there's a discount rate that they'll be converted at a discount, right? Or there's a valuation cap that they will be converted at this valuation. There's a fixed valuation, or there is a condition that they will be converted, whatever the valuation of the company, that's the upper cap, right? Then there's a maturity date that by the end of this period, the instrument would be converted into equity. Then there's a interest rate or a preference, a dividend percentage for these convertible notes. Then I'll take an illustration to explain you these convertible notes. So A and B are the two founders, right, of a company who are holding 5 lakh shares. So the total equity of the company is 10 lakh. Now C is an angel investor, right? So company is issuing convertible notes for 10 lakh at 4% interest and at a discount of 20%, right? So that's so this is the basic the basic between the company, that it will be a 10,000 convertible notes, 4% interest and 20% discount. Now I'll be sharing three scenarios with you. So after 1 year, the situation one would be that a company's valuation is 5 crore rupees, right? So in case the company's valuation is 5 crore rupees, so we know that our convertible notes are issued with a discount of 20%. So you will get the equity shares after 1 year for 5 crore less 20%. So at a 4 crore valuation, you will get the equity shares. So your 10 crores would be converted at a 4 crore valuation, right? So here with the 4 crore valuation, the value is coming as 40. And how much amount you're investing here now? You have invested 10,000, but you have got 4% interest also. So your total amount to be invested is your principal plus your interest amount, which is 10 crore 40,000. So you get 26,000 shares, which comes out to be 2.53% of the stake in the company. So this is situation one, wherein the valuation of the company is 5 crore rupees. Now situation two, maybe the valuation of the company becomes 500 crore. It becomes so scalable, like WhatsApp, like Ola, or like Uber. It becomes so scalable that you're so lucky that the valuation of the company becomes 500 crore. But whether you as a who has invested in the convertible notes, whether you are as lucky as that, we'll see with this illustration. Because what our terms and conditions would be, that we will be giving a 10% discount, right? Sorry, 20% discount. So at a 500 crore valuation, we will just be giving 20% discount. So we would be allotting the shares at a valuation of 400 crores, which is very high, right? So the value of the share is 4,000, and the amount to be invested is 10 lakh 40,000. So we just get 260 shares with such a higher valuation, right? So this 260 shares is only at a 500 crores, you only get 260 shares, which is just 0.026% stake in the company. So which is almost negligible. At that time when you gave the money, that time 10 lakh rupees, what a good amount. But when the company valuation was 500 crore, then you were just getting 0.026% stake. Now, this is the situation three. Here, what you're saying is that with your terms that you will be converting you will be giving 20% discount. You also said that I have a upper cap of 10 crore. So whatever the valuation of the company goes beyond 10 crore, I am fixed at 10 crore, right? So if you have a discount, so in case the company valuation is less than 10 crore, you will get the shares at that valuation minus discount. And in case the company's valuation is going beyond 10 crore, then you have an upper cap, a valuation cap fixed for you, which is 10 crore. So you will get the equity at a 10 crore. So in this case, in the previous example, I showed you that the company's valuation is 500 crore, wherein at this valuation after the discount, you get 260 shares. But now when you work with the upper valuation cap, right? So 10 crore. Now your valuation cap is 10 crore. You will be allotted shares with 10 crore valuation. So the value would per share would come out to be 100, and your 10,000 40,000 shares would be 10,000 40 100 400 shares, which is 1.3% of stake of the company. So it's very important when you're going with a convertible note, what terms and conditions you are taking with, right? So I will be going through an SHS and I'll tell you how the terms and conditions have been written, but we should keep that in mind, that there should be an upper valuation always fixed, or what discount are we going to, what time of maturity period we are taking into, what interest are we going taking. So these are few situations I've explained to you in a scenario where the convertible bonds were issued to C. So his shares were converted like this: as a valuation of 5 crore, 2.53% he got a stake. 500 crore, he just got negligible stake, 0.026. And when he has an upper cap, even at a valuation of 500 crore, he has got a 1.3% stakes in the company. Right? I hope that's clear. So I told you the primary or a direct investment, which is equity or debts. Now this is a indirect investment, wherein you can invest through alternate investment funds. So these are the funds basically wherein you can, you can go to them, you can tell them that you want to invest through these funds. So they charge 2% fees, right? And then you can invest through them. So that's another mode. Now, a question comes in, like, me as a single investor, I want to invest 5 lakh rupees in a startup, right? So there's another. Suppose Emmanuel says, I also want to invest 5 lakh rupees in a startup. Then Sandeep is here. He says, okay, I also want to invest in 5 lakh rupees in the startup, right? We all three are friends. We all three are liking that this is a nice startup. But if we individually goes 5 lakh rupees, right, then we have less of negotiation power, because the more money we have more negotiating power. So what we say is, like, me, Emmanuel, Sandeep, we said, okay, let's combine together and go to the founder with 15 lakh of rupees, right? So then we have a better negotiating power. So is it possible that can we do that, right? So that question comes up, whether it's possible. So it's possible that, if you want to, if you want, so if you want to combine together and invest, you can have an agreement among yourself, right? Or you as a team can go to the company and says, see, we are at this round, we will bring this much of amount to your company, but we will be having different investors. So there'll be one agreement wherein all the investors as one party and the company as another party, and then you can have a joint agreement and you can negotiate the terms there. And in case you want somebody to represent on the board also, so you can also appoint among each that one can be a director at the board. So you can have a joint agreement and you can invest into a company, right? There's another one form which is an organized form. The form is like, you can invest, you can become a company, right? You can form a company, and that company can make an investments into the another company. So there you can be a shareholder then in the company wherein you're getting the funds, and your funds would be invested into another company. But in case you're forming a company, then it is required for you to get yourself registered with SEBI as an alternate investment fund, right? Then you have to be a fund, and there are certain criteria for a given by a SEBI to become an IAF, right? Because under Companies Act, a company cannot only invest into the shares, right? So if a company is only investing into a share, it can either be an NBFC or a company registered with SEBI. There one other way, LLP. So people say we can form an LLP and invest into the company, but an LLP cannot be formed only for the purpose of investment. So you can form an LLP wherein you're educating the investors, and then you're making a group and then investing. So there's another way of investing, right? So yes, but a small angel investors, they can come together. They can come together as a team and they can have a joint agreement with the founders. So this is the way they can combine and they can invest, right? However, yeah, when you're having a joint agreement, it is very important that whenever you are coming up as a team, so it's very important to have a very good understanding among each other. That's very important, because you are coming up as a team, so you should know the mindset of the other person, other investor also with whom you're combining, because you're dictating your terms as a team, as not as three-person individually, but as a team. So it's important that there should be a bonding and an understanding between the team itself. So this I've told you. So now a question comes to the investor. Okay, I'm investing into this startup. How will I earn out of it? What would be my income? So one thing in the startups, generally when people invest, they don't think in terms of percentage, right? They think in terms of X multiplications. What, how much my money will get multiplied. Okay, that's good, because in startups we see that many of the startups are giving a good multiplication also. So, but in general terms, an investor earns, like, if the person is a shareholder, they are holding equity shares or the preference shares, so they'll get a dividend in the company. So, what is a dividend? So, dividend is basically the profits after, all taxation, whatever the left profit, that is distributed among the shareholders. But generally, in case of early startups, they don't distribute the dividends; rather, they keep the profits of the company for the further growth of the company, right? Then there might be a bonus shares which are being given. So bonus shares are some additional shares being given to you in addition to your holding, right? That increase your percentage. Then Profit on selling of shares, definitely. When you're holding the equity shares or the preference shares, when you're selling those shares, so whatever the profit you are earning, that could be percentage or into multiplications x, that can be a profit on your shares. And what debt holders, like if you are giving the debentures, what they are getting, so debentures are issued with the interest rate generally, so they'll get the interest on debentures. And if they are convertible debentures or any other convertible bond, then whenever they convert it into equity, they get all the benefits of a shareholder. So these are the earnings of an investor. So investor should always take care of, should always, if suppose if you have invested in a company, so I always suggest you just keep a glance on the company, have a look on the company, don't interfere into the day-to-day working, but yeah, at least ask the founders to share a monthly financials or the monthly profitability or the monthly cash flow, so that you should be aware of that what the company is doing when you have invested, in which you have invested. Like, because in case you have a listed, if you have invested into a stock market, a listed share, you can see the changes in the prices every day, right? And then in the stock market, you have all the financials of the companies which are open. You can go through them, you can see what is happening in the company. But here in a startup, you really don't have any idea. In case you have invested, you have no other ways to find out that what the promoter or founder is doing. So you should ask the founder, and it should be a part of your agreement as well, that these are the certain documents, the financials or the cash flows the founder should provide you on a monthly basis, so that you are aware of what is going on in the company. So this is the investment. This is the investor's earnings. Now, a lot of times, a lot of question asked by the investors: what is our maximum stake? I mean, if you have invested, suppose 10 million, so what is my stake in the company? How much I can lose? So you might have heard, more pains, more gains, right? So you're taking a bigger pain in startup, but you'll get good gains. So it might be that you lose the money, or it might be you gain. So if you're losing, the maximum you can lose is what you have invested in the company. And for the gains, there is no limit, no limit, right? So the maximum amount of uh, loss can be, you have invested. Suppose you have taken a convertible bonds, wherein I showed you three situations. Now situation four is, I'll tell you one more situation. In that case, you have invested 10 lakh rupees as a convertible note after the maturity of 1 year. Now, after 1 year, you said, I want to mature it, but the company doesn't have any gains. You said, okay, you redeem my convertible notes then, but the company doesn't have any profit. So how will you do it? So either everything is gone, you're going to lose everything, or you ask them, okay, you convert my equity and we'll see if the company works in the future. Or it might be that company doesn't have cash to repay you back, but the profitability of the company is going up, right? In that case, what decision you can take is, you can say, okay, you can bargain with the investor, okay, I'm not taking the money in one shot, right? I'll take the money in different tranches. So because the company is coming up into profits, the company is having profits, but there is no further investment, it is no cash rich, but it is having profits. Then you said, if I've invested 10 lakh rupees, okay, I'll take it in, suppose, 3 years, 3 lakh, 3 lakh, 4 lakh. So, that way you can negotiate with that. But the maximum loss you can have in the company is whatever amount you have invested. And the gains have no limit, it can go up to anything. Now we have understood startup kya hai, what's a startup, what are the factors involved, how should we take the decisions, what are the instruments. But now comes up, you know, how should we invest in a startup, right? We have decided, we have mentally prepared ourselves that we would be investing in a startup. Now the question comes up, okay, what I have to do now? So you have to actually go through what is the background of that startup or a promoter. So that promoter, if a promoter, so it's generally an experience. Suppose if a promoter who is working in a good company, right, and the promoter has an idea, okay, I'll do that, and he hasn't left his job as well, and he says, okay, I'm doing my job simultaneously and I'm doing my business also simultaneously. So do you really think that promoter will work for the startup? No, actually no, because then he has his interest divided, And then again, he don't believe in himself, that he cannot leave his job and give his time here, because he doesn't believe in himself whether this startup will work or not. So until and unless a promoter is having, you know uh, promoter is having confidence in itself, how can an investor gain confidence in a startup? So generally, it is generally, it's good to say that if a promoter who has left his high pay job, right, and then he has start doing the work with the startup, has come up with a startup, so then there's some credibility of a promoter, that he himself invests, he himself believes in himself and his concept, right? So you have to see what is the background of a promoter. Then you have to see the memorandum and articles of association. Memorandum and article of association is a very important document to check before investment. Because I'll tell you what is a memorandum and article. These are the legal documents of a company. These are the bylaws of a company, which are drafted at the time of company incorporation or are amended later. So memorandum basically talks about the name, the registered office of the company, what objects the companies are going for. So here you will be clear that whatever the startup is pitching you, whether these are the actual objects of the company or not, you can find out through the memorandum. Then memorandum talks about what is the liability clause. So if you're investing, you should know how much is your liability. So your liability is only up to a maximum amount, but you have to check whether memorandum is not saying anything else, right? And what is the capital? So if a promoter is wanting to issue you a capital, whether he's authorized, whether he has such capital that he can allot you, because there's an authorized capital. It's a capital from which a person can a founder can issue the shares to you. Then article of association. So this is the memorandum. It has all these 5 clauses, right? Then the articles of association. Article of association is what we call it as a bylaws of a company. It says what are the duties, what are the limitations, what are the restrictions of the directors, what are the rights, duties, liabilities of the shareholders, who can enter into an agreement, is there some restriction or not. So if you're investing into a startup, and in case the startup is already having some funds, so you'll see whether the previous fund who has invested into a startup, whether they have put in some restrictions or not. Because if they have put in some restrictions, suppose a restriction like above 5 above say 10 lakh of rupees, a company has to take the approval of a shareholder, right? So whether the person is taking that approval from the previous investor or not. So how will you get to know? You will get to know all these restrictions through the articles of association. So these are the articles, and memorandum is a very important document to check with whether there is some restriction in the company or not. Then you should see the current business plan and the future prospect, that this we have already discussed, that what the startup is planning to do, what is the future prospect of the startup. Then you should analyze the financial statements of a startup. So you can ask the startup to show the financial statements since inception, and you can see what the founder is saying and what the financials says. Financials may be into losses, right? But what is the reason of the financial losses? You should understand. So suppose I said the founder is having some money from the previous investor, so you can see how the founder is using that money, whether they are burning out the money into for the sustainability, or they are burning out the money for the future progress, right? So they are only making he's only withdrawing his salary, or he is actually investing in the salary. Suppose suppose a founder got an investment of 1 crore rupees, right? And a founder is every month taking out a salary of rupees 2 crore, 2 lakhs, 3 lakhs, 4 lakhs, right? So in that case, you can analyze that founder here, the founder is withdrawing the money, right? A founder should take, should not take a huge amount of money as a salary, because initial days the startup needs fund, right? So founder is giving his own services through that by not withdrawing much amount. Yes, founder should withdraw that much of amount from which he can sustain his life, right? But he should not, you should check that he's not withdrawing a huge amount of money. So through these financial statements, you can check whether the founder is burning money for the company progress, or he's burning money for the sustainability only, right? Then what is economic and market analysis? Then financial data, track record of the company, profitability or loss, and what are the reasons and stuff. And there then comes up the legal documents. The two legal documents I told you about, these memorandum and articles of association. Then the other legal documents you should check is, suppose Okay, I'll give you an example. So the legal documents or the other legal things. So suppose the company is having some IPR, some patents, some trademark, some copyrights, right? And you have invested in the company and you have thought that everything is in name of the company, right? So the company, the IP definitely helps into the valuation of a company, right? That's very important for a company. But say after a year you'll find out that it's in name of the promoter himself. So that will not increase the valuation of a company because it's the personal asset of a promoter. So you should find out through the due diligence that whatever the IPRs, whatever the licenses, whether the company is having all those licenses, all those IPRs or not, and if they have, whether it's in name of the company or not, because this will only add on to the valuation of a company. In case it is having, in the personal capacity of a promoter, then it will not add to the valuation of a company. So all these things you need to check, right? And apart after that, I mean, not only these, you have to see whether the company is filing its return or not on time. So, with this, you can understand the mentality of a founder, right? So, if is founder really serious? If a founder is serious, then he will do all the compliances which are necessary, be it income tax, be it any licenses, be it any act, be it MCA, ROC, any all the compliances are on time, and whether their compliances are being done or not, right? Any license required for the specific business, whether that has been taken by a startup or not. So these are the few analysis you should do before investing in a startup, right? Then comes out to be, now these are the ways how you can become a shareholder and what are the documents required to become a shareholder. So if you want to become a shareholder, there are three ways of becoming a shareholder. Either you become a subscriber to the memorandum, mean when the company is getting incorporated, you become a subscriber to it. That at the time of incorporation, you take the shares. Or maybe at a later stage, with the round of funding, you'll get the shares or CCPS or the debentures by the company, or you can purchase those shares from the existing shareholders, right? So these are the ways you can become the shareholders in a company. Then what are the documents required? So here the document required are the term sheet, the shareholder agreement, and there's a share certificate which is given to you as a proof that you are a shareholder of a company. It is given in form SH1. So what is a term sheet? I'll so term sheet is basically the terms and conditions which are signed between a promoter and an investor, which says that this is the, so it says this is the company, this much is the capital, and then it comes out of the actual term sheet which says I am going to invest this much of amount in the company. Then I'm going to invest at this valuation. This is my percentage. Or if you have some clauses, some exit clause, you can say in the term sheet. If you have some, if you this I will be telling you much in detail in SHA. I'll be sharing you an template for a share SHA. Then so it's a term sheet, but it's non-binding. Term sheet is not binding. It's just a agree. You both have, as an investor and a founder, you just have entered into an agreement that it's okay. I will invest in your company, and in lieu of that, you will give me the share certificates, and these are the terms and conditions. After this term sheet is signed, though it is not binding, but then after the term sheet is signed, then due diligence starts happening. So you see what the company is, how the company is functioning, whether it's legally it's binding up everything, it's following everything. So then the due diligence starts, and once it is completed, then you sign an SHA with the company. SHA is a shareholder agreement. And at the time of SHA, you give the money to the company and the company will give you the share certificate. So I'll just share a template. Emmanuel, we have some time.
Please go ahead.
Sure. So I'll just give me a minute. I'll just share a template for SHA. There is one more document which is coming up, these days in India, which is called iSafe. iSafe is India. Uh, so iSafe is basically, India future security. So you'll get a document for that for that. So I'll just show you a template for SHA. Just one second. I hope you can see that. So it's basically entered into between a company, then probably a director and the investor, right? So it defines wherein what the company is into, what's the capital, what is the current shareholding of a company. Then this is the important part, point number D, which is important, wherein it is showing that investor is investing this much of amount. Series is written at what valuation. So here it's at this valuation. Then what number of shares are being given at what premium. So these are the terms. It's just I've shared a template of a client with for whom we have made. So this is an important thing. Then there comes the definitions and the interpretations. So these are the definitions. So these are the general definitions, right? Then these are certain interpretations. So these are the formats, right? Now here is the investment and share issuance, wherein you say that the company shall pass all resolutions with respect to the execution of the agreement. You can ask the company for all these documents that if you've passed a resolution, you've given authority of a person that this person can sign the agreement on behalf of a company. So that's a resolution being passed by a company. Then approving the draft offer letter. So basically the company gives a draft offer letter that approves. Then the allotment of a share, and then company file form pass 3 with the registrar of companies. So you can also ask the company to provide you a pass 3 form with the challan. So pass 3 is a return which is filed with the Ministry of Corporate Affairs, MCA. So it is a registered proof that your the company has allotted you the shares, and that has been filed with MCA also, right? And then there are some confidentiality restrictions that you will not share these confidential things. The promoter will. Now there comes with the anti-dilution protection. So what is anti-dilution? So I have shown you, with the new series, with the new fundings, your shares get diluted, right? So at times you can have an agreement with the founder that whatever the scenario is, whatever the investments we are getting, but my shares should not get diluted. If I am a 10% holder, I will remain the 10% holder, right? But such type of clauses are generally not acceptable for a healthy growth of the startup. Reason being, because then big players will not invest, because there they will see the growth is not there, because every time the profitability will be given to one who is having an anti-dilution clause. So generally in that case the scalability goes down, because the big players doesn't come into these such type of entities wherein there is an anti-dilution clause. So it's always advisable not to have it. But yes, here like in one case the anti-dilution clause is there when you've got a share at a valuation at a higher valuation, but in future the company is going for some rounds at a lower valuation, right? Then you can have an anti-dilution clause that if the company is going at a lower dilution, then your shares will not be get diluted, right? Then there is another right of first refusal, that in case you're transferring the shares, then you have to first give the shares transfers to the company promoters, founders. However, you can also say that this first right of refusal should not be applicable when you're transferring to the family or family members. Then there's a tag along, drag along right. So tag along, drag along rights are like when you've got when in the new round, if you have a tag along, drag along right, that means that being an investor, and if there's a tag along right, that means you have to whenever he's giving the offer will be given to you first in your proportion, right? He has no option, he has to give you the offer, and it depends on the investor whether they want to take it or not, right? So generally there might or there might not be the tag along, drag along rights. Yeah, but in case of sale, you can have it that if a promoter is selling his shares, then there's a tag along, right? Whenever he's selling the shares, your shares will also be sold along with, right? So these are few things you can have in your SHA. You should take care of it. It's very important. It's a very important document, the term sheet and SHA. You should go by each and every word of it, because if there is anything between the lines, right, then there's a possibility that you may ruin your investment. So it's a very important document. Either take a professional for this, or if you're very sure, then you do it. Otherwise, I always recommend take a professional for the professional help for this SHA, because there could be anything between the lines in this SHA which might impact you in future. Then there's a board clause that you can say that you want to nominate somebody on your board, or on the board of the company, or you don't want to nominate somebody. So that's a board clause. Then it's an annual business plan that like every financial year, here in this agreement, the investor has said that within 60 days they have to submit to the investors the annual business plan. You can also ask the investors to provide you these documents, which I was telling you earlier also, that information, material informations. If there is any change in ownership or a capital structure, then you have to inform the investors. If there's any change in the composition of board, you have to inform the investors. So, or you can say that if a company is taking a loan, right, for an amount exceeding any such amount of rupees, then the company should intimate the investors about it, right? If there is any material change in the employment terms of the promoters or key employees, then investors should be informed. So these are certain points which you can add in your SHA, or information regarding the remuneration of directors and promoters, because it's important to know how much, as I say, how much the money they are burning out, and for what purposes it's being burned out. Then what is the information, like the auditors, or what are the related party transactions. Then you can ask them the quarterly P&L, profit and loss account, the cash flow or a balance sheet of a company, of a promoter, from the promoter, the management's report. So these are the few items you can add. Or you can say, if a company is doing any capital expenditure worth rupees this much, then it should be bring to the knowledge of the investor, right? So all these terms and conditions you can have in your SHA, right? And then there's a representation and warranties which is being given by the promoter and the investor. So these are the standards. Then there's a policy on exit. So exit policy is again very important. I'll also tell you exit policy in the next slide as well. So the exit policy is very important. It should be there that if a company is going for an IPO, right? Then the existing shareholders, the existing investors, whatever the investments or whatever the terms and conditions that they have given the investors, but at the time of going into IPO, either the founder will purchase the shares, or the person will give the shares. They will be at pari passu with the other shareholders. Pari passu means they will be at par with the other equity shareholders of the company, right? Or if there is a third party sale, suppose there is a merger, right? Then what are your terms, what are your rights? Or you can also add a clause that in case of maybe after 5 years you want to exit, so you can put in that you may exit in a 5 year, and the promoter has to take your shares at such cap value or something. You can put in with this in the exit clause. Then there's an indemnity clause, then there's a termination clause, then when this agreement can be terminated. So there's no partnership clause. So these are the general clauses, these are the normal clauses. And notices, where you should get the notice, for what, and then it has to be signed by you. And then it has got an extra that the correct shareholding pattern, the like one, the round of fundings, and details about the companies, if there is any CCPS. So this is a template for an SHA, right? So whenever you are entering, so it's an important document. I'm again saying it. Whenever you're doing an SHA, please go by each and every word of that, and bring into that whatever you want, whatever the terms and conditions you want it. So discuss with the promoter, have a negotiation with them, and get it done. And now, once everything is done, you've signed the SHA, you have given the amount. Now, a lot of people ask, how will I get to know that I'm a shareholder of a company, right? What instrument I will get? So you will get a share certificate. What is a share certificate? It's a SH1. I'm just enlarging it. It is form SH1, the share certificate. So it's basically a certificate. It may be a printout on a bond paper, or a pre-typed share certificate, but the format is same, wherein it says the company name, this SIN number, which is a corporate identification number of a company, the address of a company, Then it says that equity shares each of rupees. Here, if in case you're getting an equity of 10 rupees at a premium of 1990, that means you're getting an equity at rupees 2000. But here the equity nominal face value is 10 only. So this share certificate is issued for rupees 10, not for 2000. So here we say equity shares each of rupees 10. Amount paid up per share is again, it's not 2000, it's face value what you have paid. So it's 10. Then the registered folio number, the company will allot you a folio number. So that's a serial number given to the shareholders. So once a folio number is allotted to you, whenever you are investing again in the company, the folio numbers will remain the same. So the company will give you the folio number. Then there's a certificate number which is issued to, that's a certificate number of a company. Then it says your name, then name of shares held, and number of shares held. So then they will give you a distinctive number of these shares, and then they'll see that these shares are issued on such and such date and are signed by such and such person, right? After these share certificates are issued, right? One thing, please make sure that here in India, when these share certificates are issued for an unlisted companies, then it is necessary for the companies to get them stamped. Until and unless the stamp duty is paid on the share certificates, that's not a valid document. So you have to make sure that the company pays the stamp duty also. Generally, 80% we have seen that the promoters doesn't pay stamp duty on the shares. So make sure it is a state stamp duty. Every state has a different stamp duty. Suppose in Delhi we have 0.015%. In UP we just have a 1 rupee court fee stamp. So every Mumbai we have another percentage. In Delhi we get an online stamp paid. Mumbai we get the physical franking done on the stamps. So there are different ways, but share certificates need to be stamped. Please check that with the company. So that's the share certificate you got. Now a question arises, what is the liquidity of my shares? I've got the shares. So are my shares liquid? I mean, can I sell them? So my answer is, like, if the shares are in an unlisted startup, right, then the shares are not highly liquid. They are liquid only when you have either when the founder is buying, or when there is a merger in the company, or there is a next round of investment. Then your shares can be transferred. So you need to follow on with the investment rounds, and you can check that whether at this valuation you sell the shares or not. So my suggestion is, don't, as an angel investor, I mean, it's not to have a 15-year 16-year plan. It's again an individual's perspective to see, but one should get out of the funding if the person is getting some handsome amount, say some 2 times, 3 times, 4 times in a span of just 18 years, or in a span of 24 months. So one should try and exit. So now the question asked is, are my shares transferable? Can I transfer my shares? The answer is yes, you can transfer your shares, but then there's a single paper. So when you're a shareholder, you are exiting from the company. How will you exit? You will check this SH4. It's a share transfer form. It's a very simple paper. It's just, I'll show you the SH4, the content of SH4, and you hand over your share certificate to the company along this form SH4. Again, you have to pay a stamp duty on SH4, which is 0.015%. I think 0.025%. That's the stamp duty you have to pay on transfer of shares. So it has reduced drastically. Earlier it was much high. So then the company will pass a board resolution and transfer your shares. So it's very simple to transfer your shares. So this is the SH4 format. So here it's a format wherein you write the date of execution of that, then what is the name of a company, what is the SIN number, then description of securities, like what type of shares you're selling, what is the nominal value. I told you nominal value is the face value. Then what is the consideration if you're selling it, suppose you're selling 10,000, suppose you're selling 1 lakh shares, right, at 100 rupees. So you'll say you're selling it for 1 crore. So here the consideration will come. The consideration will be the actual consideration. Then what were your distinctive numbers, which is written in your share certificate. Then what are the transferor particulars, your particulars would come in, right? And then here the transferee particulars would come in. You're going to sign the shares here, and the transferee would sign the shares here. Then you submit this SH4 along with this share certificate which is being issued to you. This share certificate. So this share certificate has one more back, so at the back of this share certificate, there is a memorandum being given wherein the details of transfer are mentioned. So once you give the company the shares along with this SH4, the company will lodge the transfer at the backside of the share certificate. Or what the company will do, they will cancel this share certificate and issue a fresh share certificate if you ask the company to issue you a fresh share certificate. So that way you'll get a share certificate or you can transfer the shares. And in case the shares are listed on a stock exchange, you can simply transfer those shares. So, and one very important thing, if your startup is a limited company, right? So there are two types of companies, private limited and a limited company. So if your startup is a limited company, it is now mandatory to have all the shares in a demat form. You cannot have these physical copies of the shares like SH1 I showed you. You cannot transfer the shares if you don't have the shares in demat form. So your company must have taken the ISIN code, which is necessary for a company, and then you can get all your shares into your demat account, right? And then you can transfer the shares, which is very simple from a demat, like you sell it for a listed company. Probably in some time, maybe a year time or so, even it will become mandatory for all the private companies to get their shares in a demat form, right? So just keep a track of it. Then what is the taxation? Now you invested in a company, you earn handsome amount on the company. Now what is the taxation? So the tax would be, there are different taxation for different type of companies if it's listed or unlisted. So in case of unlisted company, so if you have shares, you hold the shares for less than 24 months, or you have shared, so it's a short-term capital gain or a long-term capital gain. So for the shares of an unlisted company, it is 24 months. If you're keeping the shares with you for 24 months, then it's a short-term. For less than 24 months, it's a short-term capital gain. For more than 24 months, it's a long-term capital gain. So if you're having a short-term capital gain, it would be like a normal slab, whatever the slab you fall in, 10%, 20%, or 30%. And if it's a long-term capital gain, that it would be at a flat 20%, right? And in case of a listed company, so the period is not 24 months, it's 12 months, right? Earlier, in case of listed companies, the long-term capital gain was exempted, but now it is taxable. It is exempt up to 1 lakh, and beyond that, it is taxable at a rate of 10%. And the short term, if you're keeping a security for less than 12 months, it's taxable at 15%. So this is, and what is it, and on what amount, right? So it would be the amount you've got on sale minus the amount you have invested. That's the amount on which capital gain is levied. Right now, it's an exit clause. So an exit clause, I told you. So exit can be, whenever there's an IPO in a company. So whenever the company is having an IPO, you can ask them that you want to sell your shares, or you will get an equity which you can sell in free market, or you can transfer your shares. You can transfer your shares to the existing founders. You can transfer your shares in the follow-up rounds of investments, right? You can tell the founder that you are interested in selling your shares, maybe at this discount, or maybe at this valuation, right? So you can transfer your shares, or whenever there's a merger and acquisition, then you may transfer your shares. So this is an exit option. So this is all about it. So I hope I've cleared what a startup is, how to make the investments in a startup, what are the instruments, what clauses you should keep in mind. So any questions?
Thank you, Rupali. That was too much of information.
Yeah,
Thank you so much.
Lot of information.
Yeah.
Thank you, Rupali. And the video will be available for everyone to review. So if you have any questions, I'm sure we can get to you through your email. So I'll share your email with everyone. Because I guess there were too many touch points there. And I think any specific doubts would not even have got registered as of now. So thank you so much. And it was really a wonderful presentation. It was really informative. Thank you for your time and thank you for your efforts.
Thank you.